Okay, introduction to financial statements. Depending upon the form that your business takes, you're going to have 4 or 5 financial statements that you're going to be expected to produce annually. If you're a sole proprietorship or a partnership or an LLC, you're going to be expected to prepare annually an income statement, a statement of owner's equity, a balance sheet, and a statement of cash flows. If you're a corporation, you're going to be expected to produce annually an income statement, a statement of shareholders' equity, a balance sheet, a statement of cash flows, and a statement of retained earnings. So, in the case of a sole proprietorship or a partnership, you have your income statement. Now, your income statement is all your revenues less all your revenues and gains on transactions less all your expenses and losses on transactions, and that's going to give you something called net income. Essentially, it's all your temporary accounts, your revenue accounts and your expense accounts. You're deducting all your expenses from all your revenues, and that comes up with net income. Okay, now there's tax in there and that kind of thing, but we're just keeping it simple for right here. Revenues, all revenues, less all expenses, net income. Now that net income gets dumped into the statement of owner's equity. If you're a sole proprietorship or a partnership or an LLC, it's in the statement of owner's equity. The statement of owner's equity is going to consist of a beginning balance amount and then any additional contributions that the owner has paid into, or owners have paid into the business. Maybe they've come up with cash and they've contributed an extra $10,000 in cash, or maybe they contributed a car with $20,000. And by the way, I want to point out, anything, regardless of the business form, when an owner contributes something to the business, a tangible asset like a car, a desk, a computer, or money, that asset becomes the business's asset. It is no longer the owner's asset. And I've heard of cases where business owners purposely do that as a way of like hiding assets. Like maybe they're involved in some kind of a divorce or some kind of personal litigation. And so they'll roll their assets over into the corporation or the business entity in the hopes that, hey, it's now owned by the business, so you're trying to sue me, I've got nothing. I don't know how that works with sole proprietorships and general partnerships, because remember, there's no legal differentiation or separation between the two, so I don't think that'll work. Maybe if you're an LLC or corporation, you can get away with it. So I think that the form of business you take is going to be pretty important, whether or not that succeeds or not. So anyway, so again, your statement of owner's equity is going to begin with the beginning balance. You're going to add to that any additional contributions that were made by the owner during the current accounting period. You're going to deduct any withdrawals that the owner's made, and then you're going to add net income, and that's going to give you an ending balance for your statement of owner's equity. And that ending balance gets dumped right into the balance sheet. So this is just a rudimentary balance sheet where I said, well, my assets are equal to $600,000, my liabilities are equal to $300K. By definition, my owner's equity, in terms of the accounting equation, should equal $100,000, and that better equal the ending balance of the statement of owner's equity. Otherwise, I've got a problem. Now, if you're a corporation, it's a little bit different. The statement of owner's equity is called the statement of shareholders' equity, and you've got another financial statement to contend with called retained earnings. Conceptually, it's pretty much the same thing. Your net income from the income statement flows into the statement of shareholders' equity. No, I'm sorry, it flows into the retained earnings. Okay, so the retained earnings statement is going to start with a beginning balance. You're going to add the net income to it, and you're going to deduct from that any dividends that were declared. okay? And that's going to give you your ending balance of retained earnings. That number gets dumped into the statement of shareholders' equity, okay? So the statement of shareholders' equity is going to have a beginning balance. It's going to have any additional capital that was sold, meaning to say stock that was sold during that period. And if you sold the stock at a premium, the difference between the par value and the premium is going to be included in an account called additional paid-in capital in excess of common stock. Okay. If you issue preferred stock, it's going to be the same thing. You've got any issuance of preferred stock that occurred during that period is going to be listed there. If you issued the stock at a premium, you're going to record the premium in another account called additional paid-in capital in excess of preferred stock. Okay, so this is all going on to the statement of owner's equity, and then you add to that the retained earnings. The ending balance gets then dropped into the balance sheet, just like we dumped the ending balance of the statement of owner's equity into the balance sheet.